Hi, welcome to Corporate Finance. This is topic 2, financing decisions. So we're going through the first part of the financing decision topic, where we are looking at the theories of corporate financial decisions or the capital structure decisions. So the financing decisions, if we remember this diagram from week 1, the financing decision focuses on the financial inputs in a corporation. So how do a firm choose between different types of equity and debt in financing their operations? So this topic will cover week 3 and 4. In week 3, we focus on the theoretical framework of assessing the value of the financing decisions. And in week 4, we look at the empirical studies, right? So we look at the empirical findings of which theories are supported and which theories are not supported. So the readings for this week is chapter 12 from the textbook, Principles of Capital Structure. Also, we assume that the background knowledge for this topic is assumed knowledge. So in 2070, we look at debt valuation, we look at the pricing of debt securities, we look at the payment structure, and we introduce the risks embedded from issuing debt securities. Similarly, we look at equity pricing in 2070, and we explain the payment structure in equity issuance. So these are the foundations for this topic. So in terms of learning objectives, we introduce the concept of financial leverage in this topic. We then look at the theoretical framework of analyzing the value of the capital structure or the financing decisions. So starting from the model where the capital market is perfect, no financial frictions, we then relax the assumptions of the perfect financial markets and try to understand the impact of different benefits and costs of debt on the value of the capital structure. And we look at the implication of information asymmetry on the choice between debt and equity. We also look at taxes. So the tax treatments for debt and equity funding is different, and therefore the after-tax position of the firm would also be different, right? We finally look at the agency problems. So last week when we talked about the dividend policy, the payout policies or the dividend payout policy, we introduced one type of agency relationship where we look at the managers and the shareholders. In the capital structure topic, we have 2 types of agency problem. The first one being the managerial agency problem that we introduced from last week. And the second one is the agency problem between shareholders and debt holders, right? So debt holders and shareholders, they both share the cash flows of the firm, and sometimes their risk preferences can be different. So the situation when agency problem arises is when their risk preferences become very different. So the lecture outline is as follows. We introduce the financial leverage concept first. So we distinguish between financing risk or leverage and the business risk. We then look at the perfect market model, so the Modigliani model and Miller model. And then we try to relax the assumptions of the model to take into account different financial frictions. So the questions that we're trying to answer here in this topic is firstly, do financing decisions affect firm value, right? So we mentioned before that corporate finance is a study about financial value, right? So we're focusing on how to increase the financial value of the firm. So we only spend time and effort, the manager only spend time and effort on making a certain decision if that decision is value relevant, right? or if that decision increase or decrease the firm's value, right? How do we measure the effect of capital structure on the firm value? So if the financing structure is relevant, is value relevant, then can we assess the value of different financing decisions? Yeah. Here we have, so when we think about value, we could think about the firm value overall, or we could think about value as shareholders' value, right? So the objective of the managers is to maximize shareholders' value. Yeah. So if we think of a firm, the value of a firm as comprising of the value distributable to shareholders, so the blue part over here, and the value distributable to debt holders. Yeah. So a firm ownership belongs to financial suppliers. Yeah. So if we talk about firm value, if the manager tries to increase firm value, they would try to increase the size of the pie here. Yeah. So if a manager tries to maximize firm's value, they would try to increase the size of this circle. In that case, assuming that we still have the same debt and equity proportion, then the value of debt holders and the value of shareholders both increase. Yeah. In situations where we can't increase the size of the firm value, if the managers try to maximize shareholders' value, they might try to cut into the value of the debt holders. Yeah. So if the sole purpose of the firm is to maximize the shareholders' value, there will be situations where the managers try to cut into the share of the debt holders. Yeah. In trying to increase the equity holders' value. Yeah. So this is when we have agency issues. Yeah. This is when we have a wealth transfer from debt holders to shareholders, right? So this is the agency problem here. In the next few slides, we'll introduce the different special terms for this topic. So we talk about the types of finance. So with traditional corporate finance, we have an economy where we only have two choices, right? So we have either a straight debt security or a straight equity security. Yeah. So the economy in the traditional corporate finance model is very simple. We have only two choices, one being a straight debt and the other being a straight debt equity issuance. Yeah. We have no convertible. We also observe that the types of finance varies across countries, right? So we find that the firm's preference for financial insurances depend on the markets, on the local market itself. Yeah. So for example, in the US, the US economy is a very big economy and it's a market-based system. What it means is that the secondary markets in the US are really large and trading volume is huge, right? So they have a lot of liquid financial markets. So we therefore see that public issuances in the US are more popular. In the Europe, on the other hand, even though this is a developed market and it's also a very big market, but European firms tend to be reliant more on banks, right? So it's more or less a bank-based system. So the preference of financing for firms in the Europe would likely be different from the preference for financing in the US. Yeah. So in the in European countries, it's more likely that firms prefer to borrow from banks, right? So private debt, compared to in the US where they can issue bonds a bit more easily. Yeah. In Australia, we have a smaller economy, and also the Australian financial markets are more or less dominated by the banks. Yeah, so the lending markets are more or less concentrated on the big four banks. We do have a very liquid equity market, but in terms of public bond markets, we don't have much bond issuance activity going on. So large firms, they tend to issue bonds in the international markets. So when firms go outside and issue bonds in a different currency, we call them euro bonds. Yeah, so this is international bonds. We then introduce the concept of financial leverage. So financial leverage is simply just the proportion of debt in the firm's capital structure. Yeah. So if we assume that firms finance using either debt or equity, then this is the proportion of debt over the total firm value, right? Or the proportion of debt over equity. We talk about financing risk and business risk. So in 2070, when we evaluate a certain project, we say that the riskiness of the project should be linked directly to the volatility of the cash flows of the projects. Yeah. So business risk is risks arising from the operations of the firm. So risks that are arising from the future cash flows that the firm can generate, right? So this is more industry specific. Whereas for financing risk arises from financial leverage. Yeah. So financing risk doesn't have anything to do with how the firm operates, but it's related to the choice of finance that the firm makes. Yeah. So we'll see an example later on. So financial leverage increases the risk of the firm's equity. And we'll illustrate that point in this example here. So we're looking at example 12.1 in the textbook. Yeah. So what do we have here? So in this case, we have an unlevered firm. So this firm is financed 100% by equity, right? So we start with zero financing risk. We know that this firm is financed 100% by equity. We know that the total equity value is the product of the number of shares times the share price, right? So the total value of equity is 2 million. And given that this firm is 100% equity finance, this 2 million is also the firm asset value, right? So the market value of its asset is also $2 million. The expected earnings are $300,000 a year. We assume no taxes and everything is distributable to shareholders. Yeah, so all earnings are paid out as dividends. We then introduce financial leverage. Yeah. So suppose that this firm wants to change the capital structure. So they want to change from the 100% equity to 50 equity, 50 debt. Yeah. So the financial manager proposes that they should borrow $1 million at the interest rate of 12%. And use the borrow money to repurchase shares, right? So they basically reduce the share, the proportion of equity financing by half. Yeah. Furthermore, we want to do some sensitivity analysis where we change our expected earnings estimates, right? So we want to look at the return on assets and returns on equity at different levels of earnings. Yeah. Okay. So this table here shows us the earnings of the firm, the return on assets, and the return on equity at different levels of financial leverage. Yeah. So what we have here is we start with the same firm, same earnings, same asset base, right? So $2 million. And we're analyzing the impact of financial leverage on the firm's required rate of return on equity. Right, so in the first case, we have the existing capital structure of 100% equity financing. We then want to compare the rate of return that we get from this case with the second case, right, where we have a different capital structure. Yeah, so 50 equity, 50 debt in this case. What we have on the columns are the different levels of earnings. Yeah, so here we have $200,000 in earnings, and so on and so forth, right? So let's look at the first column first. So if our earnings is $200,000 a year, and given that our asset base is $2 million, our return on assets would be earnings divided by the asset base, right? So that will be 10% per year. We then use this these numbers to work out the return on equity. Yeah. So we know that the total earnings, the total cash flows that the firm generates are divided into two components, right? So the first component being the cash flows distributable to debt holders. The second component being the cash flows distributable to shareholders. Yeah. So in the first case where we have 100% equity financing, we have no debt holder, and therefore all the earnings of the firm can be distributable to shareholders. Yeah. So shareholders get the entire $200,000. Given that we have $2 million in equity value, so this firm is 100% equity finance, so the value of equity would be exactly the same as the value of assets. Yeah. So if we want to work out the return on equity, we take the cash flows distributable to shareholders divided by the value of equity, $2 million. That will give us 10% per year. Yeah. So exactly the same as return on assets in this case. Now we look at the second situation where we have a 50 equity, 50 debt financing. So in this case, we borrow $1 million, right? So this is our principal amount. The interest rate on debt was 12%. Therefore, the interest expense in this case is $120,000. Yeah. So before the cash flows are distributed to shareholders, the firm has to pay interest first, right? So they have to pay the debt holders first. Yeah. So from this $200,000 in earnings, the firm has to pay $120,000 in interest expense, and therefore the amount of earnings available to shareholders become $80,000. Yeah. We then do the same exercise as we did before. We're trying to work out the return on equity, and this is given by the cash flows distributable to equity holders divided by the equity value. Right. In this case, our equity value is half because we finance 50% by debt and 50% by equity. Yeah. So equity here is 1 million. And that is 1 million, right? So that gives us 8% per year, right? We repeat the exercise for the other three columns at when we have different levels of earnings. And this is what we find, right, regarding the return on equity. Yeah. So what do we see here? Now, in the case where we have no leverage, this is 100% equity financing, our return on equity would be exactly the same as the return on assets. Right, it makes sense, right? Because whatever the firm makes, distributed to shareholders directly. Yeah. When we have the debt holder in place, what happens is when the firm makes a lot of profits, so when we're looking at the last two columns here, when the firm makes a lot of profits, the return on equity would be more than the return on equity when we don't have any leverage, right? So in the presence of leverage, a very profitable firms would have a higher return on equity. Yeah. So in the presence of leverage, you earn 28% per year, whereas when there is no leverage, you only earn 20% per year. Yeah. So this happens for when the firms are very profitable. When the firms are not very profitable, we're looking at the left-hand side, right? So we're looking at the two first columns, especially the first column. Yeah. So when the firm is not very profitable, the return on equity would be smaller if there is financial leverage, right, compared to here. So the effect of leverage is therefore to amplify the returns in the good case, but also to amplify the losses in the bad case as well, right? So leverage therefore increases the volatility of the return on equity. Yeah. So this is illustrated on the graph over here. So this is the case when we have no leverage. So the return on equity would simply just be proportional to the return on assets. Yeah. When we have leverage, the story is a bit different, right? So when we have leverage, and if we have more profits, if we have higher profitability, then the return on equity increases. However, when we make losses, the return on equity would also suffer, right, a bit more. So in terms of when we look into the data, what do we see about the firm's financial leverage in different countries? Yeah. Firstly, we see that even though the financial markets have developed a lot over time, we have huge investment in technology that facilitate faster trading. We have huge trading volumes from different investment firms, right, over time. But what we see is the financial structure or the capital structure of a firm doesn't change that much over time. Yeah. So non-financial companies, they still raise funding mostly from internal cash, right? So they tend to hold cash when they anticipate that there will be new investment opportunities in the future. They also prefer debt finance more than equity finance. So if they exhaust their cash holding, they would then go into the market to raise debt securities. They only use equity when they can't borrow anymore. Yeah. We also see that high growth companies tend to depend more on share issues or on equity finance. Yeah. So when we look at the private equity market, for example, so private equity is when we have venture capitals investing in startup companies. Yeah. So these are equity financing, right? We also see that the leverage ratio tends to vary with industries, where the more tangible industries or industries where there are more tangible assets, they tend to have higher leverage ratio. Right. Industries where firm values depend a lot on patents or on intangible assets, innovations, for example, they tend to stay away from debt financing. Yeah? So these firms tend to be financed either by private equity or they hold cash. Yeah. We also see that if the firm is operated in a more concentrated industry, like in Australia, we have the telecom industry. Yeah, we have Telstra, we have Optus, we have Vodafone being the big players, right? So if firms are operated in these kind of industries where they have higher market power, then they can afford to borrow a bit more, right? So the financial leverage for these firms tend to be higher. Okay. We also find that the financial sector, so banks or insurance firms, so on and so forth, they tend to have higher leverage, but this has nothing to do with the optimal choice of leverage, right? That's just a different type of business. Yeah. So banks, their business is to lend money and borrow money from depositors, right? So they raise funds from depositors, and therefore their leverage ratio tends to be much higher. We also distinguish between company financing or the overall capital structure and project financing. Yeah. So when we talk about the capital structure, it normally refers to the overall financial structure of a firm, whereas we can also have project financing where different projects are financed a different way, right? So in the next few slides, what we'll do is that we'll go through a theoretical framework of how we assess the value of the financial structure or financing decisions, right? So we go back in time, we go back in history. So before all these studies are done, and we ask the question, where do we start, right? So how do we start to understand the value of the financing decisions? Yeah. So we do the same thing like what we did before for the dividend policy topic. We start with a model where we specify all the conditions under which the financing decision doesn't change anything, right? So the financing decision doesn't matter at all. Okay. So we start again with the Modigliani and Miller model in 1958. So a few decades ago, yeah. So the idea is very basic, yeah. So if we can find out when the financing decision is not relevant, then we can use that as a starting point to analyze and to pinpoint when the financing decision would be important. Yeah. So the M&M model specifies the conditions under which the financing decision doesn't affect firm value. Yeah. So the conditions of the model, as we described before, are a perfect market conditions, right? So after M&M, we relax the assumptions of different of no financial frictions, and we try to understand then different factors, how different factors can affect the value of the financing decisions. Okay. So in our M&M 1958 model, we have a perfect market no transaction costs, no trade barriers, and no information asymmetry. We also have no taxes. We also assume that all borrowers can borrow at the same rate, right? So this is a very important assumption under this model, because essentially this assumption allows investors to create homemade leverage, right? Okay, so the effect of this assumption is that if the investor can create homemade leverage, that means that they can change the leverage that is made at the firm level, right? So if the firm targets a 30% leverage ratio, if the investor doesn't like that target, they can change the ratio, the leverage ratio of their own portfolio to a higher or the lower number, depending on their risk preference, right? We have homogeneous expectations, meaning that everyone have the same assumption for the fair price of the firm, right? Same estimates for the fair price of certain assets. We have no cost associated with the liquidation of the company. We'll talk about that later on. And we also have a fixed investment policy. So the effect of having a homogeneous expectation for everyone and no information asymmetry is that everyone has a full set of information to value a certain investment, and therefore, because we have homogeneous expectation, we then have the same estimate of the value of the investment project, right? We borrow and lend at the same rate, meaning that we also have the same risk, right? Everyone has the same riskiness. We also assume that this rate is a risk-free rate, meaning that no one defaults, right? So no default in our model. So we assume there's no cost associated with the liquidation of a company, meaning that when the firm goes into bankrupt, it will just be a transfer of ownership from the shareholders to debt holders, right? So once the ownership is transferred, the debt holders would still operate the firm with the objective of maximizing the firm value, right? So they will still choose the same investment options as before. Okay. So this condition basically take away the cost of bankruptcy, right, or the financing risk of debt. Okay. So in the M&M model, under the perfect market condition, the authors model the behavior of two firms with different leverage ratios, right? So we have two firms in our model. A lever firm and an unlever firm. So one firm has leverage, one firm has debt, the other firm doesn't have any debt. Yeah. %, equity, sorry. Okay. These firms are also identical in their businesses, so it's same business risk. The only difference between these firms are the way they are financed, right? So firm U, the unlevered firm, this is an all equity firm. Firm L is the lever firm, and this is financed partly by debt and partly by equity. Yeah. So under this model, and in an economy where we only have two firms, same business risk, different financial structure, Modigliani and Miller proposed three different theories. So with proposition 1, this is about firm value. So proposition 1 says that the market value of a firm is independent of its capital structure, right? So the implication of this is that when we change the leverage ratio, it doesn't change the value of the firm at all. It only changes the way that cash flows are divided between lenders and shareholders. Yeah. So the prediction of this proposition is that the value of the lever firm would have to be equal to the value of the unlevered firm, right? So if we see the market pricing these firms differently, right? So if the market prices these two firms differently, then there is mispricing, yeah? So whenever there's mispricing, people would arbitrage, and by doing arbitrage, the prices in the market would then be brought back to equilibrium, right? Okay. So given that the financing decision is not important, it should not be priced in the market, right? Which means that if there is a deviation or if there's a difference in value between the lever firm and the unlevered firm, then there will be arbitrage opportunities, right? Because of the mispricing. So given that we have homogeneous expectations, we all have the same estimate for the firm's fair value. If we see that the market have two different prices, then we know one is underpriced relative to the other, or one is overpriced relative to the other, right? So what do? We buy the underpriced firm because we know that this is underpriced. We sell the overpriced firm, yeah, we know that it's a bit overpriced. Okay. So if everyone follows the same strategy, they would push up the price of the undervalued firm, and at the same time depressing the price of the overvalued firm until the two values equal, right? This is when we have no more mispricing and the market becomes equilibrium. So for example, if we have if the lever firm is overvalued compared to the unlevered firm, then an investor can sell the shares in the lever firm and buy the shares in the unlevered firm, right? Also, a condition for the arbitrage strategy is that we have to be exposed to the same risk for two different strategies, right? So for two different positions, we have to have the same risk, yeah? So if we are an investor in the lever firm, we are exposed to the financing risk of this firm, and therefore we want to replicate the same risk exposure for our new investment, right? And we do that by borrowing personally, right? So leverage our own portfolio. We then buy the shares in the undervalued firm, right? So we sell high and we buy low, we earn the difference in between. So this firm, the amount of equity distributed to shareholders in this firm is $500,000, equal to the earnings before interest, right? Because we have no debt in this case, as the risk exposure of the lever firm, right, of the old investment, right? So this new investment have the same risk but higher return, right? So this is what we call a risk-free return, yeah? Okay. So I'll upload the workings for this question on Blackboard later on as well. So M&M Proposition 2. Proposition 2 basically tells the same story as Proposition 1, but from a different angle. So in Proposition 1, we look at firm value, so that was the dollar figure. Now in Proposition 2, we look at the cost of capital, right? So this is a percentage number. So this proposition says that the total cost of capital, which is K0 over here, doesn't change with financial leverage, right? Doesn't change with financing risk. The only thing that changes with the financing risk is the cost of equity, right? So the cost of equity of a levered firm is equal to the cost of equity of an unlevered firm plus a financing risk premium. Yeah, this is the financial risk premium. So this bit over here is dependent on financial leverage, whereas the total cost of equity or the total cost of capital doesn't change at all, right? So what that means is that given that we don't have any change in the cost of capital, the only person who bears the financing risk is the equity holder, right? So the cost of equity increases with leverage, which means that the equity holder requires higher return when the firm leverage increases, right? Meaning that they are the one that bears the financing risk. Yeah? The total cost of capital doesn't change, right? So the cost of capital K0 doesn't change with the debt equity ratio or the leverage. Any change in leverage would be accompanied by a change in the cost of equity. Yeah. Proposition 3 is related to Proposition 2. So because the total cost of capital doesn't change with the leverage, then the appropriate discount rate that we use to discount future cash flows for investment projects would not depend on the capital structure. Yeah. So this one would be depending on the riskiness of the investment itself, not the capital structure of the firm. Right. This is what we did before, right, in the NPV analysis, or net present value analysis that we did into 070. Yeah? So basically it tells the same story again. The financial risk or the risk arising from financial leverage doesn't change the appropriate capital structure of the firm, and therefore it doesn't change the discount rate that we use to discount investment projects cash flows. Okay. So after the M&M model, later models take into account the different frictions in financial markets to try to understand the value of the financial structure. Right. So we have taxes, we have financial distress costs of debt, we have information asymmetry, and we have agency costs. Yeah. So if we introduce taxes in the perfect financial markets, we have no taxes, meaning that we don't have any government, right? So the government doesn't play any role here. The government doesn't have a claim on the firm's assets, right? So we assume that this bit did not exist before. Now, if we introduce taxes, that means the government has a claim on the firm's cash flow, so that the shareholders and the debt holders only have this part. Yeah. So to maximize the firm value, we're still assuming that the firm value is equal to equity value plus debt value. To maximize the firm value, therefore, we want to minimize the tax payments, right? We want to minimize this part over here. Okay. So how do we do that? Yeah. So under a classical tax system, dividends have no tax benefits, whereas interest expenses are tax deductible. Therefore, debt financing gives a tax shield, right? So debt financing has a tax advantage. Okay. So the implication of this is that if a firm has to pay a lot of taxes, then they would have more preference for debt financing. Yeah. So we mentioned before, debt creates a tax shield from the interest deductible from interest expenses, from the tax deductible from interest expenses. So in this case, increasing in leverage would increase the firm's value because it reduces the tax liabilities. Yeah. The implication here is that if a company have to pay a lot of taxes, they would have an incentive to borrow more, right? With the imputation tax system, the story can be a little bit more complicated. Yeah. So with the imputation tax system, it creates an advantage, a tax advantage for dividend income, right? What it means is that with the imputation tax credits, it reduces the total tax that the firm has to pay, and therefore the effective tax rate would also be reduced. Yeah. So if the firm has less tax liabilities, the value of debt would become smaller. The value of the tax shield on debt would become smaller, and therefore we expect that firms operating in this kind of situation, they don't have much of a preference for debt. Yeah. Investor clientele. So when we talk about debt, similar to the dividend policy topic before, if investors have different after-tax positions, depending on the different capital structure, then they would prefer the capital structure that minimize their tax payments, right? So we have investors that have a classical tax, that are subject to a classical tax system. So if we have like a US investor, they are not entitled to the franking credit. Yeah. We have other investors having the imputation tax system, so those are the local investors. We also have investors of different personal tax rates. So some investors would prefer debt if they value the tax benefits of debt more, and some investors would not value debt too much because they don't have to pay tax that much at the start anyway. So in equilibrium, we have a clientele effect where investors form clienteles and invest in a manner that best suited to their particular tax positions. Right. So, for example, if our majority shareholders are U.S. shareholders, U.S. institutions, then they would prefer higher debt because they are not entitled to the franking credits. Yeah. So how do lenders monitor firms? Yeah. We have covenant restriction. An example of a covenant restriction is the maximum leverage ratio restriction. So a bank lender, for example, they can condition that the firm cannot borrow more than 80% of the equity value. Another example is that we might have like a minimum coverage ratio. This covenant requires that the firm has to meet a certain amount of earnings, right? So their earnings have to be, say, 100% of their debt obligations, at least 100% of their obligations, for example. Right. So a lender, a bank, can require that the annual earnings have to at least meet the debt obligations in a certain year, right? So what this does is that it increases managers' incentive to improve firm performance, right? Otherwise, if you violate a covenant restriction, the lender can force the firm into bankruptcy. Yeah. Lenders can also monitor by requiring the firm to disclose more information. Yeah. In terms of the cost of debt financing, so we mentioned before that with debt financing, the debt payments are obligations, meaning that the firms cannot skip their debt payments, right? So if the firm's earnings in a certain year, if the firm makes losses and they can't pay their debt, there's a risk that the lender would take the firm into court and file for bankruptcy, right? So the direct cost of financial distress is therefore the bankruptcy costs. Also the legal costs related to the bankruptcy process, right? The indirect cost of a financial distress is that if the lender files for bankruptcy, then the firm's business is put into liquidation, right? So in that case, everything is delayed. Managers have to spend time and attention on the bankruptcy case itself, not on the operation of the firm, right? So we lose sales, we lose efficiency, and we lose the effort and time of the managers. Yeah. Also, ex-ante costs of financial distress. So before the firm goes into financial distress, a high leverage can be costly already, right? So if you have a very high leverage, if you maximize your borrowing capacity already, the next time when you go to the debt market or when you go to the bank to raise new funds, the risk premium that the bank charges in that case would be much higher than before, right? Banks also tend to be stricter for firms with a higher risk of financial distress, right? So they set the covenants more restrictive. They also require more collateral, meaning that the borrowing capacity of the firm would therefore be even more limited, right? Managers only care about the equity value, right? So they only care about maximizing this part over here. So what they do is that they don't try to increase the total firm value. They just try to cut into the share of the debt holders. Yeah. So we talk about the first type of agency costs arising from the conflict of interest between shareholders and debt holders. So in this case, this is an incentive problem. Yeah. So managers in this case have an incentive to substitute low risk investments with high risk investments, right? Because shareholders prefer high risk, yeah? So in theory, all firms should only choose positive NPV project because that increases the total firm value, yeah? So we talked about the total firm value before. So here we're trying to increase the size of the circle, yeah? Which is the size of the total firm value. Now sometimes increasing the total size of the firm value might not necessarily increase the value of the shareholders. Okay, in particular when we have a financial distress situation where it's very likely that the firm is going bankrupt in the near future. Yeah. So when a firm goes bankrupt, the ownership is transferred from shareholders to debt holders, and therefore any effort that we do today to increase the firm value would only benefit the lenders in the future, right? So for some risky projects, even though they have low expected returns or low probability weighted expected returns, but in the best case, they can have very high return, right? So for example, we have gambling, right? Or lottery. So with lottery, the winner of a lottery can earn like $20 million or something, but the chance to win is very small, right? So the expected return from a lottery is not very high, is very, very low, yeah? But because in financial distress, people worry more about the best case scenario, right? So if the risky investment, in fact, can generate the best case return scenario, then the firm gets out of bankruptcy, yeah? So in this case, the risky project becomes very attractive because it can help the firm to get out of bankruptcy. But at the same time, the NPV of the project might be negative, meaning that if the investment is selected, there is a high chance that the lender would lose in the future, right? So when they get the ownership of the firm, they have a lower firm value. Okay. So the implication here is that the high risk project has a negative NPV, even though it has a very high best case return. But the negative NPV would reduce the total firm value. However, it increases the value of the shareholder, right? So in this case, the shareholder has a possibility at least to get out of bankruptcy. Okay. But the value of the debt holders would definitely fall, right, because of the negative NPV value. We then look at the underinvestment problem. So the underinvestment problem is another incentive problem, and it goes a little bit the opposite with the overinvestment problem, right? So with this problem, we have the same situation where the managers try to maximize shareholders' value, and in some circumstances by transferring the wealth from debt holders to shareholders, right? So basically stealing the money from debt holders to shareholders, yeah? So in this case, a firm rejects a low-risk investment with positive NPV because it's not in the interest of the shareholders to contribute additional capital to finance the new investments, yeah? So suppose that you are going bankrupt tomorrow and you have $1 million to invest today. To make this investment, you require an additional funding of $500,000. Now you can ask the shareholders to make this contribution so that you can make the investment and increase the overall firm value. But because the firm is going bankrupt anyway, and the ownership would be transferred to the debt holders, the return of the investment would not go to the shareholders, right? So in this case, shareholders would likely reject the investment project, right? So if we can't invest in a positive NPV project because of this agency problem, it means that the firm value will reduce, right? Okay. We also have other types of agency costs. Sorry, this is costs here. Should be costs here. So we have claim dilution. This is when we have an existing debt, and when we issue a new type of debt, the new debt can be ranked higher than the existing debt, right? So we basically front run the existing debt holder. Okay. Also, the firm can also use the dividend payout policy to transfer wealth or to steal the wealth from lenders to shareholders. So again, we have a situation where the firm is not trying to increase the overall size of the company. They only try to increase the size of the shareholders' wealth, right? So to summarize, in terms of the benefits of the debt, we have tax shields, being the taxes deductible on interest payments. We also have debt obligations, reducing the free cash flows and therefore reducing managerial agency costs. We have the role of the debt holders monitoring the firm by using covenants, by using loan maturities, for example, and collateral requirement, right? But that also has costs, right? So we have financial distress costs, being the risk that the lender can take the firm into court if they can't meet the debt obligations. We also have a new type of agency costs, where shareholders and debt holders can have conflict in interest, and in that case we have a distortion of incentives, right, by the managers. So we introduce basically the different features or different concerns about debt financing. So in the presence of a new agent, the debt holder, the manager's incentive might be distorted because of all of the issues about financial distress, right? So after M&M, we have trade-off theories. So this theme of theory look at the benefits and costs of debt, right? So this is a benefit cost analysis. We also have a pecking order theory, where this theory focuses on the role of information asymmetry in explaining the hierarchy of financial issuances. We also have free cash flow theory that looks at the agency costs between managers and shareholders. Okay. So for the trade-off theory, this trade-off theory says that there are different benefits and costs of debt for different firms, and in equilibrium, a certain particular firm should be able to identify an optimal point at which the firm minimize the cost of debt, right? So there should be an optimal level of leverage that help to minimize the cost of financing. Okay. So this theory therefore implies that the capital structure is important and it has first order effect, right? So the firm actively identify an optimal level of leverage, and they would try to stick to the long-term leverage target, right? Okay. So this is on the horizontal axis. I have the leverage ratio. On the vertical axis, I have the firm value, right? So the trade-off theory is reflected by this curve over here. Yeah. So what the graph says is that when you have low leverage, right? So when you have a low level of leverage, the cost of financial distress is quite low, and therefore the benefits of debt, being the tax savings, outweigh the cost of financial distress. Yeah. When we have high leverage, on the other hand, now the cost of financial distress now become very high, and it outweighs the benefits of tax, right? So that when you have too high leverage, the total firm value would therefore decrease. Yeah. As a result, this is the optimal level at which the leverage ratio maximizes the firm value. Yeah. So this is when the firm value is highest. We then have the pecking order theory. So the pecking order theory focuses on just one type of financial frictions, that is information asymmetry, right? So given information asymmetry, we know that managers, being the insiders of the firm, they always have more information than outside investors, right? So as outside investors, we therefore are very sensitive to managerial actions, right? So if we perceive that a certain action has information, has material information, or motivated by information, then we will react to that action. Yeah. So the pecking order theory predicts that there is an hierarchy of financing where the firm prefers to use internal funds or cash flows. If they have no more cash flows to use, they would then issue debt, followed by hybrid securities, and finally, as the last resort, they would rely on equity, right? So why is that the case? Yeah. So why do we see that firms prefer debt financing over equity, right? So what's wrong with equity financing? So if we think about a manager's incentive, when he or she issues a new type of security, if we want to issue securities in the market, we want to issue the securities at the highest price as possible, right? Which means that when the firm issues security in the market is therefore likely to be buying an overpriced security. Yeah. So if shareholders believe that they are buying an overpriced security, they would stay away from that security. Yeah. Also, if you think about a very profitable firm, if we have a very well-run firm, a very well-operated firm, and the firm generates a lot of profits, then what do we think about the cost of debt for that firm? If the firm is very financially healthy, there's no apparent risk of default, then the lenders are likely to charge a lower risk premium, right? So the borrowing costs for these firms should be cheap. Okay. So for these firms, debt financing should be cheap. What about equity financing for profitable firms? So if you are a very profitable firm, and suppose that you are the only shareholder, you are entitled to the entire profits of the firm, right? So if the firm makes, like, say, $5 million, you as the only shareholders, you get the whole $5 million, right? Suppose now that you issue shares into the market, so you issue 50% of the ownership into the market, yeah? Meaning that you're sharing half of the profits with other people, right? So the cost of equity in this case is $2.5 million, right? So half of your profits, yeah? So the more profits the firm make, the more expensive the cost of equity is, right? Meaning that profitable firms, they don't like to issue equity, yeah? If they can borrow debt cheaply, and if they don't have to sacrifice their profits, then they should not then they should not want to issue equity, right? And vice versa, right? So if we believe that profitable firms don't like to issue equity because they don't want to share the profits with new shareholders, then the only people that issue shares are the unprofitable firms, right? So firms with low profits, the relative cost of equity would be low for them, right? So if the market believes that, then every time a firm issue equity into the market, the firm would be perceived as not performing very well, right? So that's a negative signal. Okay. So because of this signaling effect, the cost of equity is quite high, right? So equity is always used as a last resort, yeah? we didn't talk about the free cash flow theory. So the free cash flow theory is what we introduced before. We have firms with a lot of cash flow. So we have mature firms, for example. We have a lot of cash flows, but we don't have any new investment projects to invest in, right? So what do we do with the cash flows? If we have a manager operating the firm on behalf of shareholders, and they have their own interests as well. So if they are left by themselves, if there's no governance, then they tend to use the free cash flows on spending that benefits themselves first, right? So they can increase the size of the firm by buying different smaller firms to increase the size of the total firm, right? So this is what we call empire building. So the larger the size of the firm, the higher the compensation of the manager, okay? And also it increases the reputation of the manager, right? So these actions increase the value to the managers, but not necessarily increasing the value to the shareholders, yeah? So in this case, to reduce this type of agency problem, we can have a debt holder into the company. So the payment of the debt holders the payment to the debt holders is an obligation, and therefore it reduces the total size of the free cash flows, right? So that's all for the for topic 2, financing decision. So for the first part of topic 2, we look at the theoretical framework, where we use the different theories to try to understand the value of the capital structure, right? Or to understand the effect of different types of capital structure on the firm value, yeah? So we look at the different benefits, but also the problems of using debt financing, yeah, relative to equity financing. So what we'll do next week is that we'll go through the empirical literature, where we look at how the data agree or disagree with different theories.